Imagine waking up tomorrow owning one of the biggest construction companies in America. Cranes lifting steel into the sky, excavators tearing through earth, hundreds of workers on your payroll, and a client list that includes governments, developers, and Fortune 500 companies. You'd assume you're rich, instantly. Because construction is a trillion-dollar industry. Skyscrapers cost hundreds of millions of dollars. Highways cost billions. Even a single luxury home can bring in a profit that looks life-changing. But here's the uncomfortable truth almost nobody outside the industry understands. Most construction companies are one bad month away from collapse. Not because they aren't busy, not because they aren't skilled, but because of something far more dangerous than competition or bad luck. And near the end of this video, you'll discover the one hidden reality that explains why even massive, world-famous construction firms, companies building bridges and stadiums, have filed for bankruptcy while sitting on billions of dollars in signed contracts. Once you understand this, you'll never look at a construction site the same way again. So let's start from the beginning. At first, this business looks incredibly simple. A client needs something built. A construction company builds it, money changes hands, everyone's happy. But that surface-level story hides one of the most complicated financial machines in the entire economy. Construction isn't really about building things. It's about managing risk, timing, and enormous piles of capital, all while betting on projects that can take years to finish and can be derailed by a single delayed shipment, a lawsuit, or a change in interest rates. This is why people misunderstand the industry so badly. They see the finished building. They never see the 2 years of financial tightrope walking that happened before the ribbon-cutting ceremony. Now think about this. Construction companies don't all look the same. Ownership in this industry comes in wildly different shapes, and each one carries a different level of risk. At the bottom of the pyramid, you have small independent contractors. One person, a truck, and a handful of tools. Low overhead, but almost no room for error. A single unpaid invoice can wipe out their entire month. Above them sit regional firms. These are the companies you see building apartment complexes or retail centers in a specific city or state. They've scaled up, but they're still vulnerable to local economic downturns. Then there are national and international construction giants. Companies capable of building airports, dams, and entire city districts. These firms often operate as corporations, sometimes publicly traded, with shareholders who expect consistent returns even when individual projects lose money. There's also a category most people forget about entirely. Government-linked construction firms, often working through public contracts to build infrastructure like roads, bridges, and military facilities. These companies deal with a different kind of risk. Not market risk, but political and bureaucratic risk. And finally, private equity has quietly become one of the biggest owners of construction companies in the world. Investors buying up firms, squeezing efficiency out of them, and either scaling them or selling them a few years later. Different ownership, different incentives, but every single one of them faces the same brutal financial reality once you dig into the numbers. So what are you actually buying when you own a construction company? This is where most people are wrong. You might assume you're buying buildings, but a construction company rarely owns the buildings it constructs. Instead, you're buying something far more expensive and far less glamorous. You're buying equipment. Excavators, bulldozers, cranes, cement mixers, dump trucks. A single heavy crane can cost over $1 million. A fleet of 10 pieces of heavy machinery can easily represent an investment of $5 to $10 million, depending on size and specialization. You're also buying licenses and certifications. Contractor licenses, safety certifications, specialized permits for electrical or structural work. Without these, you can't legally bid on most serious projects. You're buying relationships. Contracts with suppliers for steel, concrete, lumber, and electrical components. These relationships often determine whether you get materials on time or get stuck waiting months during a shortage. And you're buying something invisible but incredibly valuable: reputation. In construction, your bidding history and your track record of finishing projects on time is often worth more than your equipment because it's what convinces banks and clients to trust you with the next multi-million-dollar job. This leads to an even bigger problem. Because none of this comes cheap, startup costs in construction are brutal. A small residential contracting business might start with $50,000 to $200,000 in initial equipment, insurance, and licensing costs, but a mid-sized commercial construction company capable of bidding on office buildings or retail centers often needs an initial investment in the range of $1 to $5 million just to acquire equipment, secure bonding, and cover early payroll before the first major contract closes. And large-scale infrastructure companies, the ones building highways or industrial plants, can require startup capital exceeding $50 million once you include specialized machinery, engineering staff, and compliance costs. Here's the part that shocks most people. Even after spending millions to start, a construction company still might not see a single dollar of profit for its first year or two because of one detail almost nobody outside the industry understands. We'll come back to that later. First, let's talk about how construction companies actually make money. The primary revenue stream seems obvious. You win a contract, you build the project, you get paid. But how you get paid varies enormously, And this is where the real financial engineering begins. Some contracts are fixed price. The company agrees to build a project for a set amount, no matter what happens with material costs or delays. This is incredibly risky for the contractor, because if steel prices spike halfway through construction, the company eats the difference. Other contracts are cost plus. The client pays for materials and labor, plus a fixed percentage as profit. This protects the contractor from price swings, but clients often avoid these contracts because they feel less predictable. Then there are time and materials contracts, common in smaller projects, where the company charges based on actual hours worked and materials used. Beyond the main contract, there's secondary revenue almost nobody talks about. Change orders. When a client requests modifications mid-project, often at premium prices, because at that point, switching to another contractor would cost even more. Experienced construction companies sometimes intentionally price their initial bid low, knowing that change orders during construction will make up the difference. It's an aggressive strategy, but it's shockingly common. There's also hidden revenue through equipment rental. Larger firms sometimes rent out their idle machinery to smaller contractors between projects, turning expensive assets into an additional income stream instead of dead weight sitting in a yard. And recurring revenue exists too, especially for companies that offer maintenance contracts after a project is finished, inspecting and servicing buildings, elevators, HVAC systems, or infrastructure for years after construction wraps up. But here's where everything changes. Because having revenue and having money in the bank are two completely different things. This is the hidden truth we promised at the beginning. In most industries, if you make a profit on paper, you're financially healthy. In construction, that's dangerously false. Here's why. Construction projects can take months or even years to complete. During that time, the company has to pay for materials, wages, fuel, and equipment upfront. But clients often only pay in stages, sometimes 30, 60, or even 90 days after an invoice is submitted. This creates a massive gap between when money goes out and when money comes in. And that gap is where companies die. Imagine a construction company wins a $50 million contract, expected to bring in a healthy profit over 18 months. On paper, that looks like a fantastic deal. But if the company has to pay $4 million a month in labor and materials, and the client is slow to release payments, the company can run out of operating cash before the profit ever arrives. Even while technically being profitable, this single mismatch, called negative cash flow, is the #1 reason construction companies collapse, even ones with strong contracts and skilled workers. And this tiny detail costs companies millions, sometimes leading to bankruptcy even at the height of apparent success. Now let's follow how the money actually flows through a real project, because this reveals just how many hands are involved before a single dollar becomes profit. It starts with the client, whether that's a developer, a government agency, or a private company, releasing funds according to the payment schedule outlined in the contract. That money flows to the general contractor, who is responsible for the overall project. But the general contractor rarely does all the work themselves. Instead, they subcontract specialized work to electricians, plumbers, steel workers, and concrete specialists, each requiring payment for labor and materials, often before the general contractor has received their own payment from the client. Simultaneously, suppliers need to be paid for materials like steel, lumber, and concrete, and these prices fluctuate constantly, sometimes rising or falling by 10 to 20% within just a few months due to global supply chains. Meanwhile, the construction company has to service any loans taken out to finance equipment or bridge cash flow gaps, adding interest payments into the mix. And running quietly in the background the entire time, insurance premiums, safety inspections, and legal compliance costs continue accumulating regardless of whether the project is ahead of schedule or behind. By the time a project is finished, dozens of separate financial relationships have to be settled, and if even one client delays payment, it can create a domino effect through the entire chain of subcontractors and suppliers. This is where most people are wrong about construction profits. The revenue might look massive, but the expenses eating into it are relentless and constant. Labor alone often represents 30 to 40% of total project costs, especially for firms handling specialized commercial or industrial work. Equipment maintenance is another silent expense. Heavy machinery requires constant servicing, and unexpected mechanical failures can halt a project for days, creating costs that weren't in the original budget. Insurance is enormous in this industry, covering workers' compensation, liability, and equipment protection. For companies handling large-scale projects, insurance premiums can represent millions of dollars annually. Then there's debt. Most construction companies rely heavily on financing, whether for equipment purchases or bridging cash flow gaps between payments, and interest on that debt eats directly into already thin margins. Marketing might seem unnecessary for an industry built on contracts and bidding, but building a reputation and maintaining relationships with developers and government agencies requires ongoing investment in business development. And technology costs are rising fast as companies adopt project management software, drone surveying, and building information modeling systems to stay competitive. But here's what almost nobody realizes. Beyond these expected expenses, there's an entire layer of hidden costs that can destroy a project's profitability overnight. compliance, and regulation changes can force a company to redesign parts of a project mid-construction, especially with evolving safety codes and environmental standards. Environmental risk is massive too. Discovering contaminated soil, unexpected groundwater, or protected wildlife habitats during excavation can halt a project for months while resolving legal and environmental requirements. Legal risk is constant. Construction is one of the most litigated industries in the world, with disputes over contract terms, defects, delays, and payment disagreements. Legal battles can drag on for years and cost companies millions in fees, even when they eventually win. Operational risk includes something people rarely think about. Weather delays. A project scheduled for a 6-month timeline can stretch to 9 months due to unexpected storms, freezing temperatures, or flooding, and every extra month means extra labor and equipment costs without additional revenue. So after all these expenses, hidden costs, and cash flow challenges, what does profitability actually look like in construction? This is where the numbers surprise most people. While profit margins vary by project type and location, general contractors typically operate on net profit margins between 2 and 6%. Specialized contractors handling technical work like electrical or mechanical systems can sometimes achieve slightly higher margins, often in the range of 8 to 15%, because of their specialized expertise. Compare that to industries like software or finance, where profit margins can exceed 20 or 30%, and you start to understand why construction is considered a low-margin, high-risk business. Break-even points depend heavily on project size and overhead, but many construction companies need to be actively working on multiple projects simultaneously just to cover fixed costs like equipment leases, insurance, and administrative staff. Return on investment can be excellent for companies that manage risk well, sometimes reaching 15 to 25% annually for well-run firms. But for companies that mismanage cash flow or take on too much debt, returns can turn negative fast even while revenue continues climbing. And this fragile balance explains why construction has one of the highest business failure rates of any major industry. So why do construction companies actually fail even when they seem successful on paper? Competition plays a role, especially in markets with too many contractors chasing too few large projects, driving bid prices down to unsustainable levels. Bad management is a constant threat too. Poor project scheduling, inaccurate cost estimating, and weak communication between subcontractors can quietly bleed profit out of even the most promising projects. Wrong location decisions matter more than people expect. Expanding into markets with unpredictable regulations or unstable economic conditions can turn a profitable local business into a financial disaster. Excessive debt is one of the most common killers. Companies that overextend themselves financing new equipment or expanding too quickly often find themselves unable to survive even a temporary slowdown in new contracts. And broader economic problems, like rising interest rates or material shortages, can devastate an entire industry overnight, tightening margins that were already razor-thin to begin with. This is exactly why even massive, world-famous construction companies have filed for bankruptcy while holding billions of dollars in active contracts. The contracts were real, the revenue was real, but the cash wasn't there when it was needed most. Now let's look ahead because the construction industry is changing faster than most people realize. Automation is transforming job sites. Autonomous bulldozers and excavators are already being tested on major infrastructure projects, reducing labor costs and increasing precision. Artificial intelligence is being used to predict project delays before they happen, analyzing weather patterns, supply chain data, and worker productivity to help companies avoid the exact cash flow disasters we just discussed. Prefabrication and modular construction are growing rapidly too, allowing companies to build sections of buildings in controlled factory environments before assembling them on site, dramatically reducing weather-related delays and labor costs. Drones are becoming standard for site surveying, replacing expensive and time-consuming manual measurements. And sustainability requirements are reshaping the entire industry, with green building codes and energy efficiency standards forcing companies to adapt their materials and processes or risk losing access to major government contracts. The construction companies that survive the next decade won't just be the ones with the biggest fleets of equipment. They'll be the ones who master financial timing and risk management better than their competitors. So let's go back to the beginning. Imagine waking up tomorrow owning one of the biggest construction companies in America. Cranes in the sky, hundreds of employees, contracts worth hundreds of millions of dollars. You'd assume you're wealthy beyond imagination.